I'm going to show you an example of a earnings prediction and how to use an earnings prediction to make a handsome profit in a short time period. So I'm going to be using ACN as an example because this is a recent earnings play that I ran, and I'll show you the results. In my earnings newsletter on Seeking Alpha, I published this earnings prediction on March the 9th. As you can see, on March the 9th, it was around trading at 102, around there. And it slowly moved up until the day of earnings, where it spiked about $9 here. Now, I actually played this. I could have played earlier. I should have played earlier, but I actually ended up buying around this time. I bought an option, not a big investment, but $200 turned into $460. So as you can see, I bought on the 21st and I sold on the day of earnings, and that brought me 100% ROI. Now the question is, how did I know that they were going to post a positive earnings surprise? Well, earnings prediction is an art in itself, and it's something I've been looking into for the past year or so because I've been burned many times before for holding a stock or an option during earnings season and having without making a prediction, just holding on to that is dangerous because it could be that the earnings surprise goes the wrong way and you lose money even though the general technical trend was correct. So I looked into this so that if I'm holding something during earnings time, I know which way it's going to go. And these days, as you can see, I am doing actual earnings predictions and trades based on that. So I didn't hold ACN. I bought an ACN only a couple days before the earnings report came out, and then I sold after that. So that's an easy way to swing trade. Now, I'm going to show you the analysis for ACN, but I'm also going to go a little bit beyond that and show you what I generally do to predict earnings. And most of these are statistically backed. All right. So as you can see, an earnings prediction can, if you're in the right direction, can make you a lot of money. This is an earnings surprise. Generally, what you see is earnings in line with the analyst's estimates, and if that's so, you don't see a big jump. It depends on the stock, but usually it sticks around where it should be. Only during surprises do they jump up or jump downward. Now, the last earnings prediction, the earnings estimates from the analysts are called consensus, and the last consensus was going to be EPS of 5.22. Let's see here, but what they got was 5.21 to 5.32. So that was a positive earnings surprise. And you can look into the earnings surprises. You could just type in ACN earnings history, and you're going to find it on the NASDAQ website. And what you'll see is a consensus of EPS and then a surprise. So what we had was a 13% surprise, significant, and it will obviously rise the price of the stock. So the consensus was 1.18, but the real EPS was 1.34. Now, for this particular stock, ACN, one of the things I noticed, well, let's just go through the entire thing, all right, one step at a time, and then I'll tell you the things I didn't look at in this particular earnings consensus. The first thing you should probably know about earnings is that the technicals often matter. They often predict which way the earnings is going to go. And that could be due to insider trading, or it just could be due to smart investors who have good information on the fundamentals of the stock. The general idea here is that if a stock is trending upward, and I didn't know this at the time, like I said, I wrote that article on the 9th, but it still was trending upward even before that. If the stock trends upward toward earnings, you're more likely to have a positive earnings surprise than a negative earnings surprise. And likewise, if it's trending downward, you're more likely to have a negative earnings surprise than a positive earnings surprise. That's a statistically significant finding. So always look at the trend. The technicals don't really matter that much, but the trend does. The second thing you want to look at is seasonality. Now, for a lot of these stocks, the earnings are related to the cyclical characteristics of that company. So with ACN, a lot of analysts believe that it's a cyclical company, even though it's a consulting company. And generally, a consulting company is going to be the same. It's not like fruit where you have a certain season where a lot of people are buying. Consulting companies are usually pretty much booked throughout the year. So one very interesting thing I found in this company, ACN, is that analysts believe that the odd quarters, this quarter and this quarter, take dips, and the even quarters are higher in EPS. Now, I found that when I looked back through ACN's history, and I'll show you in a second, I found that not to be true. So I saw a very good advantage here, because what really is happening is that ACN is improving itself consistently, but analysts believe it's going to take a dip, go up, take a dip, go up. So you'll see higher EPS, lower EPS, higher EPS, lower EPS. And we could take advantage of that incorrect assumption and know that actually EPS is overall growing as a whole. And even though they were predicting a lower than November EPS, I was pretty confident that they were going to have a higher EPS. And I'll show you why. Let me dig into, I think this is it. So if you run the data and you look at the EPS, you see that there might be a trend where the evens and the odds here switch, by the way. The evens might be lower and the odds might be higher. But overall, if you take a rolling annual estimate of these, you see the EPS is overall increasing. So you might take slight dips, but you're not going to take a huge dip like the analysts were predicting. You're not going to drop one from 1.31 to 1.18. It's more likely that if you take a dip, your dip's probably going to be somewhere like maybe 1.25, which still beats on EPS. So that was an important aspect of this prediction. Now going back, the fundamentals are very important, and for a company like ACN that has lots and lots of international clients, they're making money in local currency and they have to convert it back into US dollars. Now right now, the US in the past quarter, actually, when you do an earnings estimate, you want to look at what happened in the past quarter. Now in the past quarter, the US dollar was at a very high strength level compared to all these other currencies. So you've got the foreign exchange issue that's going to hurt the overall earnings and revenue of ACN, because when you convert from local currency to USD, you lose USD essentially. Now, what a lot of people didn't realize is they were simply looking at revenue. They weren't looking at costs. ACN, yes, they make a lot of money overseas, but they also employ a lot of people overseas, so they get cheaper labor. So analysts were forgetting the fact that they also spend less money. They might be making less money, but they also spend less money because they're both making money in the local currency and spending money in the local currency. And I think that's something that was ignored in these earnings predictions. So I believe that analysts were putting too much emphasis on Forex, and that was going to hurt the consensus EPS forecasts, but not the real earnings. So and we could talk about that in a second. We can dive into how analysts get their numbers, but the fact of the matter is that analysts generally don't have time to look really in depth into every stock they give EPS forecasts on, and it's kind of surprising because that's their job. They're supposed to be accurate with giving forecasts on EPS and revenue, but they really don't have the time to do so. They are looking at so many stocks at a single time, they can't think about each one in depth like individual traders and investors like ourselves can. Now the final thing down here is reactions. You always need to go back through the earnings, and you can go to whatever ticker you want in Seeking Alpha and click on earnings, and I would just scroll down and see when they beat it. So check it out. They beat, right here, beat the earnings consensus. Did the stock go up or down? Because 40% of the time, the stock will move in the opposite direction. So what you need to do before putting money down on an earnings prediction is you need to go through all these earnings and see if there's a pattern. If when the stock beats on earnings, so beats by this, beats on revenue, you can go through Seeking Alpha. It's very useful because it'll tell you what happens in 3 areas, whether it beats on EPS, whether it beats on revenue, and then how the stock reacts. So here it was down 4.4, and that was because of guidance. So there's 3 main issues here. There's EPS, there's revenue, and there's guidance. Those can all affect the stock price, and you need to just see if there's a pattern by going through all this data and checking whether the reactions are in line with the earnings surprises, because 40% of the time they're not going to be. Now, if you know that a certain stock reacts appropriately, then you can make that earnings play and bank on the stock going up with a positive earnings surprise. If you know that it reacts the opposite way, which I haven't found yet, but I mean, some of them really do react opposite when, let's say, you meet earnings but don't beat them. The stock takes a dive. In that case, you still have an earnings play. You can buy puts or you can short the stock. But in general, whatever you do with whatever company you're looking at, you need to make sure that the reactions are in line with the earnings reports, the earnings surprises. You can't just be logical and think, oh, there's going to be a positive earnings surprise here, so the stock's going to go up. That's not true in every case. So make sure you dig through those past earnings reports and see how the stock reacts to positive and negative earnings surprises. What else? Drift predicts earnings. I talked about that already. Yeah. What about analysts? So let's say you want to look at earnings estimates. What I usually do is I go to MarketBeat, type in the ticker, and then type in analysts. And it's going to give you a list of, I think this is correct. Let's see here. Yeah, so this is correct. So you just go to Google, type in your ticker, type in MarketBeat, that's a site we're using, type in analysts, and it'll give you all the analyst ratings for that stock. Now, because there's so many different firms, you don't know which one to trust. And what you could do is you can take an aggregate of them all, and I've done that in the past, but using the consensus generally doesn't really work out that well. And what I found is that the firm that is best at predicting a certain earnings report is not a specific firm. For example, I'm not going to say Morgan Stanley predicts earnings better than Barclays. What I'm going to tell you is that the firm that issues the most ratings to a certain stock probably has more time to analyze that stock and is going to be more accurate for those analyses. So if you see, for example, we got Morgan Stanley, Barclays, JP Morgan, Citigroup. I see two. No, I don't. This is a bad example, but and this is why I didn't include it in that earnings prediction in my newsletter. But if you do find a certain firm that gives out many predictions throughout the year, and I'm not seeing that here. For example, here we got Cantor Fitzgerald gives one prediction every 3 months, which is okay. But for more popular stocks, you'll see maybe Goldman Sachs over and over. And if you do see that, you're going to want to look at their predictions for the price targets more and put more weight on their predictions than other analysts. Generally, analysts are not very good. Their jobs, it's not about having skin in the game, and that's a different issue, so I'm not going to talk about that. But if you do see a certain analyst that is giving if you arrange it by firms, you see the firm that's giving the most predictions, that's the one you should probably trust more than others. So here we might trust JP Morgan and BMO Capital Markets more than anyone, and then look at the most recent one from that. So BMO Capital Markets says it's a hold, but that's after the earnings came out. What about before the earnings came out? They also gave it a hold. So I mean, they didn't predict the earnings surprise, the positive earnings surprise that we actually saw. You don't want to put too much emphasis on analysts, but it's a good start if you're looking for a price target. Really, what we learn from an earnings report is the information that was hidden from most investors. So when that surprise comes out, we learn something that most investors didn't know before that earnings surprise came out, but we probably could have figured that information out before it came out. You get what I'm saying here? For example, we found in the most recent report that Forex really didn't hurt them that much, and I predicted that. Now, if you go and look at the conference call after earnings with the company will tell you that yeah, Forex hit us maybe 20% of our, or it affected us maybe 6% of our revenue or of our bottom line, which really isn't a lot because they're still growing revenue double digits in the local currencies. So I mean, it's something that I was able to predict, but most investors just didn't see it. And that's what we learn from an earnings surprise. Now, moving forward, we know because of that earnings surprise, we know that ACN is not really affected that much by Forex. So now it's probably priced correctly. And into the next earnings surprise, you're going to need to look at another fundamental aspect. We don't know what that is yet, but you're going to need to look at why analysts are predicting a certain earnings, a certain EPS, a certain revenue, and if those fundamental aspects really hold true. So you've got a little bit of pattern analysis, and you also got some fundamental analysis that will allow you to accurately predict an earnings surprise. Now, how do you play the earnings surprises? Well, there's the obvious way: buy an option or buy some stock before the earnings comes out. Alternatively, short or buy a put if you believe that the earnings surprise will be negative. But another way to play this is through volatility. I'm not a huge fan of doing this because playing volatility to me, well, I could talk about that in another video, but if you want to look at the volatility, here's volatility before earnings. For most companies, the volatility will spike. For ACN, for example, we see it double. Now, just playing that, you can play that through an option strategy called a strangle or a straddle. You can buy volatility, let it rise, and then sell right before earnings. So you don't have to be right about the direction. You just have to be right about volatility rising. The reason I really don't like this that much is because the price of the stock has to move to a certain extent. It doesn't have to move in a certain direction, but it has to move to a certain extent. So, for example, let's say we got in at March 9th when I wrote that article. Now, buying a straddle or a strangle, you buy a call option and a put option. Now, clearly the call option would have made money, but the put option would have lost money, just not that much because volatility rose. And as volatility rises, the put option also rises in value. What I really don't like about this is twofold. One, you have to move a certain distance. If you don't move far enough, that strategy, even though you're right and that volatility is going to rise, you lose money because of theta decay. That's the first thing I don't like about it. The second thing is if I'm good at predicting earnings, then I should know that the stock's going to go up. So why would I buy a call and a put when I could just buy a call? So that would convert a straddle, for example, to a pure call. So I could buy one call, sell it before earnings, then buy another call, and then sell after earnings, which is two plays, and logically you might put them into one play. And the problem with that is you might lose money on the entire play if you're wrong with the earnings surprise. So you might just want to do it as a two-step process: buy a call before earnings, take that volatility and the rise in the stock, sell it, and then buy another call, perhaps of less value, for example, a $200 call. And then if you're wrong, you haven't lost a lot of money because, well, $200 is not a lot of money. So that's pretty much it. I think if you put in the effort, pretty much anyone can see where analysts go wrong with earnings predictions. Sometimes they're right. A lot of the times they're right. And in that case, you just need to find out how a stock reacts when earnings predictions are met. Now, if they're met and the stock moves up, that's good. So you don't have to find a positive earnings surprise to play that. You just need to see that the stock moves. You just need to see that the company will meet the earnings predictions, and then you could play the same way. But really, all you have to do is put in the effort, look at the fundamentals of the company, see what the analysts are missing, and that enough will allow you to make these kinds of plays where you make 100% ROI in 3 days or 1 day. I could have easily done that the day before earnings and then sold on earnings. If you put in the effort, you can do this all the time. Not all the time. You can make mistakes, of course, but it's a pretty decent trading strategy if you're into swing trading or day trading. Well, day trading is different. If you're into swing trading, this will work out for you and you can get this really high ROI in just a short time period. If this video was helpful, please like and subscribe for more videos of this type. And in the comments, if you have any questions or if you would like to request a certain topic or video, please do so below. I will take your requests.